and welcome to the third episode of The Resilient Investor with me, David Stevenson.
And me, Sam Ridley.
And we are together this week in a small room in a WeWork, so there'll be people shuffling along behind us, so we apologise for any noise in the background. But we're going to talk a bit more about how to pick shares. So we're going to how to understand companies, Sam.
Yes.
And we're going to talk a bit about things like what measures to use. I think you want to talk a bit about wide moat.
Wide moat and company competitive advantage, and how to find the businesses that have it. So yeah, that's what I'll be bringing up.
Okay, cool. And that is our subject matter today. And I'm also going to talk a little bit about are we still in a bear market? As we speak, it is today, Wednesday the 14th of September.
Indeed.
Yesterday was another bad day on the market.
CPI results came out and knocked the stuffing, certainly out of my portfolio. Again,
really?
For day 1,722.
So what was your worst hit yesterday?
Nvidia, 10% drop almost.
Yeah. Was it really? But I've got Nvidia.
Followed closely, I'm not a shareholder of Peloton anymore, but that was another business that took a heavy hit. I think broadly everyone shed, apart from NIO, the automaker, China electric automaker. Surprisingly, I think it was about 2% up on the day. They've been on a bit of a run, thankfully.
Yeah, but that's from a massive fall.
One of the knives I've held for a long time.
That's after a massive fall. So I suppose it's put it in perspective, really. And we're also going to talk towards the end. I'm going to bring an idea about battery metals, about the coming electrification of the modern economy. We're going to talk a bit about the metals that are required there, particularly lithium, to a less degree cobalt, actually nickel. Anyway,
interesting.
So first of all, let's just talk a little bit about how do you pick shares? How do you pick shares, Sam?
Truthfully, when I started out, as I've mentioned in previous episodes, late 2019, just before COVID, I were picking shares on businesses that interested me.
Yeah.
Plainly and simply. Businesses with products that I used, wanted to use, businesses that resonated with me, such as Disney, and still do today. But as I did my reading and learning to become more of a resilient professional investor, if I can ever be one,
you will be, don't worry.
I was learning about the fundamentals of a business and ratios to measure a business's financial health.
Yeah.
So as well as looking at the kind of about us part of a business, it was then looking at its performance.
What kind of measures have you learned to look at now?
PE ratio,
the price
to earnings ratio, return on equity, ROE,
and return on capital employed,
ROCE, debt to equity, to understand, and future cash flow is important there, to understand how long a business has ahead of it in terms of surviving on its own monies or will need further investment. They're the ratios that I look at primarily.
Okay.
I mean, there's probably 10 ratios in total. I kind of have a sheet on the desktop that I review, but they're the ones that spring to mind.
So let's unpick some of these things. So first of all, there is this distinction between kind of knowing a business and knowing its metrics, and I think a lot of experienced investors get very snotty about knowing a business and investing in what you know, because they say it's not relevant. I actually disagree. I think it is relevant, because I think if you're a customer of a business and you understand it, I actually do think that gives you a little bit of a competitive edge. So one of the reasons I'm a big fan, like you, of Disney is that I think I use a lot of Disney products and I think they're very good, and I think they're arguably better than Netflix, for instance.
Disney Plus, in my opinion,
definitely.
The quality of what they're putting out.
Absolutely, completely agree. So I think it's wrong to say you should ignore that, and I think it's not a bad idea to do what you've done, which is start with stuff that you know and then work backwards to the numbers. So I think classic example is you can, via ordinary knowledge, quite often get a better handle on a business than all these highly paid analysts are. So a classic example is Ocado. It just put out results, I think yesterday actually, which showed sales gone down. Now, that came as a big surprise to a lot of people. I don't think it came as a big surprise to anybody who's any shopping. Which is Ocado is quite expensive. And actually, if people haven't got much money, they're probably going to spend a little bit more money at Lidl, Aldi, and maybe Tesco's. So there's nothing wrong with understanding what you know, but your measures are good. So the classic one you look at is the price to earnings ratio, the PE ratio. So let's take a company that's got worth $100, and it produces $10 per share, the earnings per share of profit. Yeah, that ratio is 10, P ratio. Now, that ratio doesn't mean anything unless it's in relation. And by and large, over the sweep of history, a ratio of between 50 and 25, roughly, is within the ballpark. Yeah. If something is at 5 or 10, it's dirt cheap.
Yeah.
Usually, if it's in single digits, dirt cheap for a reason.
Yeah.
Because it's rubbish. Yeah. And basically what's happened is its earnings have collapsed.
Yeah.
But really, the market's not. It doesn't mean that a business that's got a PE of say 35, 45, or 50 is rubbish, is overpriced, because earnings per share in the P ratio is a snapshot and it's only the last reported earnings. So what a lot of people look at is they look at the forward earnings, because big companies, and even
usually by 12 months, is it?
It's 12 months. Yeah. So quite often you can look. It's not difficult to get. You can look at, even on a site Yahoo, you can go to analysts, tab, and then you can find out what they estimate the earnings per share for the coming 12 months will be, and that gives you a forward P. And a forward P is actually quite relevant. Because otherwise you could have an amazing year and then the next year is going to be rubbish, and you're all looking at last year's numbers, but actually are really terrible. Conversely, you might have a company that's trading on a PE of say 35 who's going to have a massive bounce in earnings, and actually their forward PE looks quite reasonable at 25. So,
and on those PEs, one thing I found, particularly through COVID, but also the fall after COVID, the last kind of 16 to 18 months, the thing that was going around a lot of the chat forums that I would look at, is that tech businesses particularly had very high PEs.
If they had ones at all. If they even had earnings.
If they even had earnings, because they hadn't running for that period of time. But the ones that had, that was the big thing.
And Nvidia is a classic example. Nvidia at varying points was trading at 50, 55, 60, 45, 60, 70, depending on what price it was, of earnings. So absolutely, yeah.
And that was the thing as a novice investor, when I was looking for PE ratio understanding, quite often it was actually the lower the PE, the better the value. And I don't think that's quite right with what you've just said.
Yeah,
so I was getting blinded a little bit in looking for these businesses that are on sale in essence, but probably for the wrong reasons.
Yeah, so we call them a value trap.
Yeah.
Yeah. And you've got to be very careful about those low earning, low P ratio businesses with what looks like a kind of sensible ratio. I would say pretty much all the time, any business with a single digit P ratio has had problems.
Right.
Now, that doesn't mean you shouldn't invest in it, because you can quite often get to really interesting stocks that have been beat. Yeah. But actually, it might even a negative beat. They might be losing money, whereas they've made money in the past. Actually, you can buy those rebound stocks. So a classic example, during the COVID pandemic, I put quite a lot of money into Carnival. Carnival Cruising.
Cruises, yeah.
And my basic contention was, going back to what we said earlier, was I always thought that actually cruising would bounce back after the pandemic. People like going on cruises. I don't understand why. I don't. But I understand.
You've not seen the Titanic?
Yeah, exactly. Yeah,
scarred me.
Hopefully, safety measures in cruises. And definitely navigation and radar. But I don't understand why I wouldn't want to go on cruising. But I understand why people do want to go on it. Yeah, and I felt it will bounce back aggressively. I think it might have a bad first or second year because people are a bit worried, but it will come back, and they're building ever bigger ships. I live near Southampton. You see the size of the ships; they're massive. They've got climbing walls and bloody theme parks and everything else. So I always thought, and their profits crashed. I can't actually remember. I think it might have gone negative because they lost loads of money. And that, on one respect, even if it had a PE, its PE would have been very low. But actually, it would have been reasonable, because going back to my point, your intrinsic understanding of the business market it operates in said, I think it's got a good business. I think it'll come back. Yeah. And all these people saying, people would never go on a cruise ship again because of
Petri dishes of COVID.
Well, that's bollocks, basically, because that's definitely not what's happened.
Yeah.
I was literally down in Southampton at the weekend. They had 5 cruise liners in. Yeah. Everyone there was packed, and they had 25,000 extra people in Southampton.
Yeah.
So tell me that they were worried about Petri dishes.
Exactly. And when you get to a certain age, I've got to be careful what I say, but COVID is only one end of probably many ends. So jumping on a Carnival cruise ship, exactly. You probably want to be with others.
Yeah. So low P's are a warning sign. They're not necessarily always a red flag.
It just needs further investigation.
It needs a lot of investigation. Okay. And one of the things you've really got to watch out for low PE firms is they've got a lot of debt.
Yeah.
So if you've got, going back to your gearing point. Yes. So gearings, let's say, for instance, a company's worth $100 for £100, and it's got £50, $50 worth of debt, long-term debt. That gearing ratio is 2 to 1 or 50% gearing ratio. probably okay if it's got solid cash flows.
Yeah.
That's manageable. If, on the other hand, I know quite a lot of companies in the past have had this, their gearing ratio is above 100%, i.e. there's more debt than equity, and by the way, that's the standard model in a lot of private equity, then you need to be very careful of a single-digit PE and high debt.
Right.
And particularly the thing you need to look at, zero in on the reports and accounts, the P&L, profit and loss, and go and have a look at the line in there in the P&L that says interest paid. Look how much interest is being paid on the debt. And if the interest paid on the debt, in my book, is pretty much, if anything above 50% of total profits, operating profits, you're in trouble. Yeah, because that's a business that all it needs is higher interest rates and it's dead. So P is very useful.
Which is quite apt for the environment we're in.
Exactly that. So P is very useful. Forward PE, I think, is more useful.
Okay.
I think return on capital employed or return on equity.
Yeah.
Let's define them. So all that basically means is, in a balance sheet of a company, you've got debt, you've got assets. So basically, you've got all the assets, you then deduct all the liabilities, the debts, and you end up with what's the remainder, and that's the equity. That's the shareholders' value in the
shareholders'
company.
equity. Yeah.
And then basically, what you do with return on equity is you look at the earnings, compare it to the equity left in the business. Yeah. Mm-hmm. That gives you return on equity. Return on capital employed is a slightly broader measure, and that includes debt being used in the business. And the reason for that is that it quite often makes a lot of sense to employ debt.
Yeah.
Let's say you're a big utility company, a power station only. It probably makes sense to employ a lot of debt, because you've got steady cash flows, you can pay it back, you can borrow quite cheap, and you can probably make more money running a power station than your interest is. Yeah. So return on capital employed,
equal favour to return on equity.
Yeah, I prefer return on capital employed.
Okay.
As long as the gearing is not wildly out of whack.
And actually, this is a good point to say, guys. Something that's helped me with understanding, but also snapshotting these ratios in one place, because at the beginning that was what I was finding difficult. I was trying to learn these ratios, how to work them out, and then go through the accounts of these businesses and do them myself, and it just took too much time. I didn't have a great enough understanding. You have to subscribe, but there are services out there, one being SharePad, which actually I think, David, you might have spoken to me about. SharePad, hugely comprehensive, lots and lots to look at if you have the time, but also very good. You can create your kind of views where you have your portfolios, and it will, with the ratios that mean something to yourself, you can identify the numbers
and
almost
instantly.
And puts them in really quick view. And so there are...
but you can, to be fair, you can do that on Yahoo Finance as well. But you just have to work a bit harder.
Yes, you've got to work a bit harder.
And Google Finance is about it as well. Both Google and Yahoo Finance, you just have to dig around.
So I haven't used Google. I must admit, actually, it's a good point to caveat. I use Yahoo Finance far more than SharePad. Every day I'm in Yahoo Finance just from an interest perspective. But as a kind of paid-for app, SharePad is definitely one, guys, that I'd look into if you wanted to explore what's out there. I know there's many others, but that's what I've had experience with. And
they've got to get a summary page, and they actually shove up these numbers on the summary page.
They shove up the numbers on the summary page. You can actually, I don't think you can link it to UK accounts yet, but you can put in when you buy and sell per your holdings, portfolio analysis. And it actually works really well, and particularly at end of year when you're doing tax return and self-assessment, it interlinks with that as well. So it's a really good tool, and I find it fascinating. You can screen businesses on a broader level, like when searching for businesses in sectors, or if you want businesses on wide moats or other things. So,
and we'll come to that in a second. Let's finish off the last couple of measures that I tend to focus a lot on: sales and cash flow. Sales is important because there's lots of businesses that are in growth mode. Amazon is the classic company, although it's arguably coming a bit out of growth mode, but where they've effectively said, well, we don't really care so much about the profit margin. What we really care about is, absolutely increasing sales, increasing turnover, increasing sales. And there's nothing wrong with that if you know that there are hard-headed managers who at some point are going to switch focus to making profits. So I do look at sales growth. So if something is growing by 25% sales growth a year, and by the way, there's loads of businesses that can do that, then I think compounding that, that will make a huge difference. Then the trick will be converting that into cash. That goes to my second measure I think you should look at, which is I spend a lot of time looking at a bit of the reports and accounts that no one looks at really well, which is what they call consolidated cash flow. Okay, so there's profit and loss, balance sheet, the cash flow statement. And the cash flow statement is horribly important in my book, because what it does is, it looks very complicated when you first look at it, but what it does is, because profit, earnings, we usually do. You quite often hear a thing called EBITDA, which is earnings before interest, tax, depreciation allowances, and amortization.
Well remembered.
Yeah, long.
Say that really quick after 4 pints.
Yeah, exactly. Or even after 1 pint, like it. Anyway, so depreciation is a tax. Is effectively it's an accounting, but in reality, the cash is still coming into the business. It's an accounting treatment. Yeah. So the cash is still coming. So you're knocking some money off earnings for depreciation. You've spent money on equipment. That equipment is losing its value over time. You put an allowance in. That's depreciation that comes off the. But actually, cash flow is still there. And what I look a lot at is operating cash flow. And I like looking at operating cash flow over the last 5 years. And if you're it's quite good to compare that with sales growth. Yeah. So if you've got a business where the sales growth is growing steadily and the cash flow is growing steadily as well, you know you're onto a winner.
Yeah.
Yeah. Because that is a business, it might not actually be reporting fantastic earnings, because it's got lots of depreciation going along, maybe have lots of amortization going on, lots of share options going on. But it is converting more of that sales into cash.
So can you repeat that once more? If your sales
are going up steadily and your operating cash flow is going up steadily,
you're onto a
winner.
If I had a buzzer right now, David, I'd press that horn. Nugget of information to take away, guys.
Yeah, that's the crucial thing. If, on the other hand, and this is really one to worry about, if your sales are growing and your cash flow is declining, or in fact the cash flow outflow is increasing, trouble. Because all that's happening there is they're buying market share, buying sales by effectively flushing shareholder money down the drain. Yeah.
Right.
So that's
bad on a number of reasons there.
That's very bad. Okay. So, and going back to the point about cheap stocks, we talked about with things with single P ratios. The ones that a lot of value investors like are stocks where there's a low P and actually the cash flow is quite strong. I.e. that business still producing a lot of cash flow. Because eventually, in the modern market, what will actually happen is some private equity company will come along and go, we'll grab that cash flow. We'll just literally take it private. We'll buy it at a cheap price, we'll load it up with debt, we'll then take the cash flow. So that's another plus to watch for. And I suppose that brings us to wide moat. And this is the idea that Warren Buffett particularly is championing.
Just one thing before we go into the wide moat, just really interesting what you said there. So are there private equity watch lists where private equity analysts or commentators publicly announce what businesses they're looking at? Or not so much publicly because it's competitor.
No, but there are definitely analysts and there are definitely investors that spend a lot of their time looking for PE targets, private targets. And what you tend to find those targets is in more mature sectors. So more established sectors. They tend to like companies with solid sales growth, not massive but solid, keeping their market share, producing lots of cash flow, tick. Not too much debt because they're going to lay them on more debt, so they don't like too much debt. They said a low valuation. And what they like to do in the past, slightly changed, in the past is they quite often will take out loads of costs and they'll boost profitability, boost cash flow. In more looking to the future, you're finding a lot of companies, private companies, buying smaller businesses that aren't to scale and then putting them all together in one big entity. Okay, and then that big entity can have the advantage of scale because the bigger you are, you can drive costs. Okay, so which brings us nicely to the wide moat, and effectively, it's Warren Buffett's one of Warren Buffett's ideas, which is it's the linking theme. It's quite a good. It's like a public stock market way of looking at private equity. Private equity, what they like, as I said, are businesses with lots of cash flow, and a solid business. What wide moat investors like is a business with a very strong competitive advantage. Quite often lots of brand value, lots of intellectual property that's not probably properly,
tangible assets
or intangible. So a classic example is a lot of consumer brands companies have got fantastic business with their brands, but because it's quite difficult to put a value on intangible assets, like a brand or an IP, like some clever tech. So Amazon's, let's use that as an example. The amount of clever IP that Amazon is building in its warehouse is massive. They're spending a lot of money on it, and that it's very difficult to put a value on that. How do you put a value on that? So you want a business with a competitive moat, which is lots of intellectual property, lots of brands. You want a business where they're probably first, second or third in the market. Exactly. They've got a role. They're really strong in the market. Yeah. You probably also want a business that has been growing its sales and its earnings in a fairly steady compound fashion. Yeah. What I mean by that is that every year or most years, sales and earnings are growing.
Yeah.
You're probably also looking for an operating margin, which I haven't mentioned before. That's effectively, every $100 you sell, you make a $20 profit margin. So a 20% operating margin is pretty good. Yeah. An operating margin that's 2%, it could be wiped out overnight. Lots of big events. Yeah. 20%, and if that margin is both steady and even better. So I would say the classic wide moat business at the moment, in my book, and I've championed it a lot, are the index people like MSCI and S&P Global. The reason they're classic wide moat business is that there's a lot more money going into ETFs. They need an index. Investors would prefer to invest in an ETF in an index that they've heard of. So that gives those big brands very strong pricing power. There's lots of barriers to entry. Yeah. So there are rival brands coming up. Yeah. It's quite difficult to muscle into that business because there's a concentrated bunch of buyers of the product, and they quite often like to stick with who they're with. And there's a lot of incumbency buyers. Yeah. Their margins are fantastic. Yeah. They generate shed loads of cash. Yeah. And they are very conservatively managed. Their balance sheet is fairly strong. So lots of barriers to entry, very strong operating margin. That turns into strong cash flow. Lots of intellectual property, lots of brand value.
Interesting. And something that when looking into kind of wide moat businesses that I found quite useful, although only one of a business that does this, Morningstar have an index wide moat businesses. But they recently put out some research into undervalued wide moat businesses after the recent 2.5-3 years, which for someone like me who looks for those opportunities was a really interesting list to see. And there were businesses on there such as Boeing, BAE,
great business.
Even Amazon. They've actually Experian, McDonald's. So
And one of the things worth saying, all of those businesses deploy vast amounts of capital.
Right.
Yeah. So Boeing, massive amounts of capital tied up in their factories.
Yeah.
McDonald's, vast amounts of money tied up in their network and in their marketing.
Yeah.
Each of those businesses has got enormous amounts of capital. And the world that we live in, whether we like it or not, means you've got more capital, you've got greater scale.
Indeed.
You can buy better deals
capital
with buyers. Operating margin, exactly.
Yeah.
Capital begets capital.
Yeah. So there are lots of sources out there, guys, to identify and look into wide moat businesses, and then put your own screens to undervalued wide moat businesses that will likely bounce back once we get out.
And the way if you want a simple way of doing this, completely echo what Sam says. Go and have a look at the wide moat ETFs.
Yeah, there's one called, I think, Moat from Global Exit might be that.
Yeah, there's a whole bunch of them out there. Just look for things like moat in the ETF title. Yeah, wide moat or that kind of thing, and then just go and have a look at what they invest in. Yeah. Have a look at their top 10 stocks. Yeah,
definitely.
And then I would be tempted just to get all the ETFs. There's probably no more than 10 of them out there. Yeah. Just look at their top 10, look at which stocks are owned by virtually all of them, and that pretty much tells you they're the winners.
Another buzzer. Ding. Very good. No, that's something I've been looking into, so I'll keep you posted.
Right, so idea-wise, or you got something first, go for it.
No. Well, I thought we were going to cover off just briefly a bit about why interest rates rise matter.
Yeah.
That was quite important considering what's going on.
I'm about to say, as we speak, the market went down yesterday because it got spooked by higher inflation, or at least high inflation numbers, and investors are worried that will mean ever higher interest rates.
Indeed, although I have a view on that.
Go for
it. They seem to be looking, because when you look at inflation more generally, we seem to be coming down slowly but surely, not going up, with a view that Q1, Q2, we're still high, but it's not increasing at the rate it was. That peaked around June or July.
Of decline.
So we are declining, and it seems that the Fed are looking backwards rather than forwards to understand that it is on a decline. Yes, the measures they're putting in place might mean a recession is due next year, but I always find when the market spooks like this, it's reacting to something that's almost already priced in and has happened already, and we're on a decline. So why didn't prices improve? Was it just based on the fact that the numbers were a little bit worse than we expected? And do investors like us not look forward but actually current and backwards?
The short answer is because the central banks have said that they will have a target range around 2%, although that's slightly wavered over the last few years. In reality, I don't think they care if it was 3 or 4. Certainly not. And they don't mind it being an average, i.e. that one year it might be 4, next year it might be 1, but averaging it 2 or 3 years. In reality, that is the level they want it at. So
Right.
when it's at 9 or 10,
Doesn't matter.
still way off the mark. Yeah.
Okay.
And what they're worried about is that will just basically mean that and they're right to in the UK, there'll be lots of unions demanding, 9% wage rises, and then that creates its own spiral of expectations.
Okay.
Yeah. So that's what worry about. That certainly the US Fed will only really be happy until inflation is back in the box. And by back in the box, we probably mean it's probably trending below 5. Yeah. And the reason it will be trending below 5 is because you'll be in a recession or slowdown. And I'm afraid that the central banks really only have one core tool for fighting the kind of inflationary circumstance, and that's interest rates and bludgeoning a recession.
And higher interest rates generally mean lower business or equity prices. Because cost of borrowing and everything else for businesses and individuals goes up.
Yeah,
so that's why it's a bad market
it's actually
for price.
multi-layered. So yes, cost of borrowing goes up. That's bad. You end up in a slowdown in a recession. That doesn't help sales growth. Doesn't help profits. Also, if you increase interest rates, then a lot of the financial models that you compare a share price versus something called the discount rate, which is what cash basically gives you.
Yeah.
As that cash rate goes up, let's say you had a business that was producing, cash, we call cash earnings yield of say 7%, and then interest rates are 1%. You've got 1%, 7%, 6% gap, and it's like, you're doing really well. But if interest rates, if cash is making 4%, and you're maybe going down to 6, or 7, back at 7, then that's not a very big gap, because you can just virtually earn the same money investing in cash. And so the models that we use to put a valuation on lots of things can account. And the last thing, perhaps arguably the most important thing, is that frankly, if you get savings rates at 4%, and we may not be far away even in the UK from that, maybe 6 months, why don't you stick your money in cash? Now, people will say, oh, well, inflation's at 9. But actually, 4 or 5% being paid just to sit on cash, quite attractive. Yeah, particularly if equities are losing, your shares are losing, and bonds are losing. Yeah,
probably the only time that cash is a good idea, to be honest.
So there's lots of alternatives. So that's the reason why it's a pretty. And you're right to say that what matters is expectation. So it's not expectations of inflation; it's expectations of central bankers.
Yeah.
So you need to be looking at how worried and nervous the central bankers are. Because you're right, inflation, if we might all expect inflation to slow down, but if central bankers are still nervous, it doesn't matter because they'll still increase interest rates. And by the way, the prognosis is grim for the UK because basically our inflation rates are even higher than virtually anybody else's.
Yeah.
We're a much more open economy.
Hugely high.
Yeah, and I think that the Bank of England has been regarded as being behind the curve and might have to be more aggressive, which means they might definitely have to kick interest rates up quite aggressively, pushing us into a sharper recession. I think there's a chance the US may avoid a full-blown recession. It may have a slowdown. It may avoid, but I can't see it.
And can I just ask, when this peak moment happens, does this spell opportunity for any type of business out there? Do private equity houses look at markets like this and think they can get...
Well, at the moment they're terrified. They hate it at the moment because all their valuations are going down, the cost of debt's going up. So they're venture capital is only just getting used to it. So venture capital's got at least 2 years of pain ahead. Private equity is already, the red marker pen is coming out and their valuations are going down. I'll tell you what, when you think that effectively interest rates are going to start to head down fairly aggressively, that's the time to buy equities.
Got you.
And actually might be the time to buy bonds, actually. Because let's just say you could get 4.5% for lending to the US government for 10 years. Now, that's about long-term average, but for the last 20 years, that's way above the average. And if you think we're heading back to low interest rates again, there's a fair chance we are, then actually those bonds might be a brilliant idea. Okay. So I'm going to finish on just an idea to bring to you, which is I think that investors, particularly young investors, should look out for the new electric economy that's coming. Yeah. We are going to have to electrify lots of stuff. We're going to have to electrify everything from planes. You've got electric planes, not massive, but I think it might be a bigger thing in short haul. Electric cars. We're going to have
public transport.
Electric public transport. We're probably going to have to get rid of gas central heating and replace it with forms of heating that are powered by electricity. Lots of things are going to get electrified. And if you electrify everything, that means you need to invest a lot more money in renewable power and that kind of stuff. But you also need to invest a lot more money in things like batteries, store it. You also need long-term storage as well, because batteries are great. Your phone is great for storing power for a day.
Shelf life is low, isn't it?
But it's not going to stay like that for a month or a week. So long-term storage is the holy grail. But certainly, energy storage is a big thing. And be that energy storage in your car, or be it on your phone, or be it in your house, Tesla home, what they call it, home.
Yeah.
That market is huge, and the people supplying batteries, sadly mostly Chinese, so names like CATL, and there are some Japanese names.
There's a lithium one, Ganfeng.
Ganfeng, very successful company. Yeah. The Chinese have done brilliantly in the electric battery market. They've done a fantastic job, and all credit to them. Sadly, I said sadly because I think they've left us in the dust, basically. Some of the South Koreans are in that market, some of the Japanese are in that market, LG, Panasonic, but even then they have factories. So that market is a very interesting market, and you're right, Ganfeng, CATL and BYD, which is a big electric car in China, Warren Buffett owns a big share. They've done very, very well. But all of these require minerals, rare earths and just classic metal, battery metals. The battery metals classically are lithium, everyone knows about that. They're cobalt, nickel, even copper is required within an electrified grid to get the power around. You need more copper. So I think it's worth paying an awful lot of attention to the battery metal. Everybody's become very focused on the rare earth, and they are relevant for things like dynamos and motors and stuff. But even nickel is hugely important in the world. The biggest nickel mines in the world are around India.
And how would you, David, on rare metals? How do you invest? What would you?
There are two ways of doing it. Well, three ways of doing it. First of all, you can find companies that have big mining or do refining, because refining is as important as it. And there are some Australian companies, there's a called Linus, that's very big in a lot of the battery metals, massive mines out. Mostly
Canada as well, I think.
Glencore are fantastic in this. They've got a massive business in cobalt. Cobalt can be replaced, so it's not elemental. And a lot of cobalt comes from the DRC, the Democratic Republic of Congo, which has got lots of ethical challenges. Glencore is very big. So you can invest in the miners. Okay. And they've all got varying portfolios of battery metal. You can also invest in actively managed funds. So probably one of the funds that does a lot of work, it's not only investing, it's BlackRock World Mining Investment. It does invest in a wide range of mining companies. It's got quite a heavy exposure to the battery.
Okay.
And the other one you could do is ETFs, exchange traded funds, and there are very specific ETFs that actually look at battery. I think Global X have got in America a lithium and battery metal ETF. But throughout the ETF market, there's more of these thematic ETFs.
I think it's called LIT, actually.
Yes, I think you're right.
Ticker LIT, LIT.
Yeah. And they will invest in, so for instance, some of the biggest copper miners. And copper's relevant because, as I said, it's, if you're going to electrify more grid, you exactly wrap everything in copper. So one of the biggest copper mines in the world is in Chile, owned by a company Antofagasta, which is actually London quoted. Nickel, a lot of it is in Russia. Problematic. I would say ETFs, a few actively managed funds, and mining companies. I suppose the last thing to say on mining companies is a lot of people go for early stage mining. Glencore isn't early stage mining, very
so that's more risk on, presumably early
stage.
Absolutely. Because they need funding to keep mines going.
That's exactly it. And there's lots of, the London market is full of these mining minnows, they're called. And people go mad about this stuff. They've got an amazing deposit of X, fill in the battery metal in somewhere. Usually
a war zone.
Usually a war zone,
or risk.
Or Canada sometimes. Because Canada seems to have a lot of stuff as well. And look, massive profits have been made in that. And I'm not going to say massive profits haven't been made, but massive losses have been as well. So it's a very much more risk-on game.
One for maybe more of the experienced investor than someone of it is,
I mean, a lot of the people I know who make good money in the mining mints have been actually who came from the mining industry.
Got you. Well,
and they sort of know their way around, because all these mining minnows put out these amazing reports of mine, gazillion tons of rare earth, and you to make head or tail of that.
So the next friend to make is a miner.
Yes, a mining geologist.
A geologist.
Or a mining engineer.
Guys and girls, look for a geologist.
All those mates of yours who were really boring and went into mining engineering and geology, suddenly
circle back.
Make friends with them again and get them to have a look at the reports and accounts of mining minerals.
Yes.
But basically, I think actually there's nothing wrong with something like Glencore.
Okay.
Glencore is
steadfast.
It's pretty well run. There are question marks surrounding Glencore, always are. But it is a very well-run professional company. They've got fantastic assets. Sadly, they also own loads of coal mines, so not the greatest business to maybe own if you care about the kind of transition to net zero. But it's just got some fabulous.
Thanks for that. Interesting.
Right, so on that theme, I think the moral of the story is wide moat companies.
Yeah.
What were the other things we picked out?
Wide moat companies and how to pick shares with a few ratios to use.
Look for forward PE.
Forward PE.
Look at the cash flow.
Look at the cash flow. Sales.
Yeah, sales growth is very important.
We did a little bit on interest rates,
Yeah.
current market snap, and then we've ended
In battery metals. And I would say
why
that,
miners make good friends.
yeah, I'd say that if you're looking for a little kind of speculative pot, battery metals is probably one of the most interesting. It's going to be a 10, 20, 30, 40.
And to end it, what's the favourite battery metal for you? If you had to pick one, you named a few, but what would you pin your master to?
Yeah, that's
at the
very
moment?
interesting. And I'm no mining engineer or geologist. There's actually
See you later, David.
Yeah, exactly. They are arguably there's a lot of lithium around. Yeah, it's not actually as rare as everybody thinks it is. And I've heard of people talking about getting lithium out of geothermal projects. Out of those steam geysers, that kind of stuff. You can get lithium out of it. So I'm less focused on lithium. Some of the smaller rare earths are interesting. I actually think, in a funny old way, nickel. I think nickel is actually really important. And sadly, the bad news there is a lot of that's in Russia, or a lot of it's owned by Chinese companies. On that devastating bombshell.
Potential bombshell. Expected bombshell.
Yeah, exactly. Thank you very much for listening to us. We'll be
Thank
back
you.
in a couple of times with a resilient investor. Bye-bye.
Bye-bye.